Hey there, and welcome back to Accounting Stuff. I'm James, and today I'll teach you almost everything that you need to know about inventory in accounting. This special compilation video is split into 5 parts. First, I'll give you a general overview of how we account for inventory. I'll show you how it's linked to cost of goods sold and the journal entries. Then we'll cover inventory systems, both the periodic system and the perpetual system. And then we'll go over 3 inventory cost flow assumptions: FIFO, LIFO, and AVCO. Make sure you watch this right the way through to the end to give yourself a full understanding of how inventory works. Let's get started. There are 2 main types of business that hold inventory: manufacturing businesses and merchandising businesses. Manufacturing businesses buy raw materials which they make into finished goods that they then sell to earn revenue. Whereas merchandising businesses do things slightly differently. They buy goods that they resell to earn revenue. Okay, so with that in mind, what is inventory? Well, in a manufacturing business, inventory is the raw materials, work in progress, and finished goods held by a business that it intends to sell to earn revenue. However, in a merchandising business, inventory is the goods held by the business. So you see, the definition for inventory in a merchandising business is a bit simpler. Manufacturing businesses hold 3 different types of inventory: raw materials, work in progress, and finished goods. Whereas merchandising businesses only have 1 type of inventory: goods. For a good to be treated as inventory, a merchandising business must hold on to it, and it must plan to sell it in the future in order to earn revenue. This future economic benefit is the characteristic that makes inventory an asset. Actually, inventory is normally thought of as a current asset, because most businesses intend to turn their inventory into cash within 1 year. But more on that soon. Let's imagine that you own a merchandising business. You buy your inventory from a supplier, and then you sell this inventory on to your end customer. Sell what? Hats. Actually, since I'm in Canada and winter's just around the corner, let's do toques instead. So you run a merchandising business that sells toques. You buy your toques from your local manufacturer at $4 a toque, which you pay for in cash, and you sell these toques on to your end customers at $7 a toque. Your customers pay you on account. How do you account for this? Well, for each toque that you sell, there are 2 transactions to consider. Transaction 1 takes place when you buy the toque from your supplier, and transaction 2 happens when you sell that toque on to your end customer. To record these transactions, you'll need to create some journal entries. So what's the journal entry for transaction 1? You've bought a toque from your supplier for $4, so you need to debit your inventory account to increase it by $4. You debit inventory because inventory is a type of asset, the A in dealer, which makes it a normal debit account. So debits increase it and credits decrease it. If you haven't heard of dealer before, it's a handy acronym that you can use to identify debit and credit accounts. I've made a video explaining what it is in more detail, which you can find up here. Okay, now where does the other side of this journal entry go? You've bought something, so you have 2 options. You could credit cash, or you could credit accounts payable. In this example, you paid for the toque in cash, so you credit your cash account to decrease it by $4. Cash is another kind of asset, the A in dealer, which makes it a normal debit account, so you credit cash to decrease it. Great, so here's your completed journal entry for transaction 1. Debit inventory by $4 and credit cash by $4. But how does this journal entry affect your books? Well, we can find that out using T accounts. T accounts help us visualize the impact of transactions on your general ledger. This journal entry affects 2 T accounts: cash and inventory. These are both assets which are held in your business's balance sheet. In T accounts, debits always go on the left and credits always go on the right. So you debit the left-hand side of your inventory T account by $4 and you credit the right-hand side of your cash T account by $4. Okay, I'm afraid that was the easy part. In transaction 2, things become a little more complicated. We need 2 journal entries to record this transaction. Oh, and if you're finding it hard to remember all of this, I've put together a 1-page cheat sheet that summarizes all of the key areas in this video. You can help support this channel by buying it on my website. There should be a link to it up here. In transaction 2, you need to recognize your revenue and record your cost of goods sold. To recognize your revenue, you need to credit your revenue account by $7 to increase it in your income statement. Revenue is the R in dealer, a normal credit account, so credits increase it and debits decrease it. But where does the other side go? Well, you've sold something, so that means you need to debit cash or accounts receivable. In this example, the customer paid you on account. That's like an IOU. They haven't actually paid you the money yet. That means you need to debit accounts receivable to recognize that you're owed $7.
Whoa. Hold on to your horses. We've got one more journal entry to do. You need to release the cost of goods sold from your balance sheet to your income statement. Here's what I mean by that. In transaction 1, you took up $4 of inventory in your balance sheet. This is your cost of goods. When you sell the toque to your customer, you'll need to release this cost of goods from your balance sheet to your income statement. But how do you do that?
Well, you credit your inventory account by $4 to decrease it in your balance sheet, and you debit your cost of goods sold account by $4 to increase it in your income statement. Cost of goods sold is a type of expense, the E in dealer, a normal debit account, so debits increase it and credits decrease it.
Nice one. So we've worked out both of your transaction 2 journal entries. But how do these affect your books? We're going to need some more T accounts.
3 more, because as well as affecting cash and inventory, these entries hit accounts receivable in your balance sheet, along with revenue and cost of goods sold in your income statement. To recognize your revenue, you debited accounts receivable by $7 and credited revenue by $7. And to release your inventory or your cost of goods sold from your balance sheet, you credited inventory by $4 and debited cost of goods sold by $4. What's nice about T accounts is that we can easily see the impact of these transactions on your books. You're left with negative cash of $4, an increase of $7 in accounts receivable, and a net movement of nil in your inventory account. You've also earned $7 of revenue and incurred $4 of cost of goods sold. These 5 T accounts make up a small section of your business's books, which in turn are used to build financial statements like your balance sheet and your income statement. The balance sheet gives you a snapshot of your assets, liabilities, and equity at a single point in time, whereas the income statement summarizes your revenues and expenses over a period of time.
So now let's recap what went down a few moments ago, but this time with the whole picture laid out in front of us.
In transaction 1, you bought a toque from your supplier. You converted $4 of cash in your balance sheet into another type of asset, inventory. At this point, you're down $4 in cash and you're holding $4 of inventory in your balance sheet. Then, in transaction 2, you sold the toque on to a customer. This transaction impacted both your balance sheet and your income statement because you released this inventory from your balance sheet to cost of goods sold in your income statement. And at the same time, you recognized $7 of revenue in your income statement and increased your accounts receivable in the balance sheet by $7 as well. That leaves you with negative $4 of cash and $7 of accounts receivable in your balance sheet. In your income statement, you've earned a gross profit of $3. Okay, so now you know how to account for 1 unit of inventory. But how do you do this for many units at the same time? We use inventory systems, the periodic system or the perpetual system. Before we jump in, you should know that I've put together some inventory cheat sheets covering everything that I mention in this video. I'll leave links to them down in the description. So how do inventory systems work?
In a merchandising business, inventory is the goods held by a business that it intends to sell to earn revenue. A perpetual system continuously updates a business's inventory account as goods are bought and sold on a unit-by-unit basis, whereas a periodic system updates a business's inventory account at regular intervals. This is usually triggered by a physical inventory count that happens at the end of each accounting period. It could happen after each month, quarter, or at the end of a financial year. So, what are the pros and cons of the perpetual and periodic inventory systems? A perpetual inventory system continuously updates your books, which means, in theory, that it's possible to see your results in real time. This system also makes it easy to track your inventory levels so you can spot stock shortages quickly. Sounds great, doesn't it? Yes, but this comes at a price. It can be expensive to set up a perpetual inventory system, and it's not always reliable. You can sometimes find differences between inventory levels in the system and what they are in real life. Some of your inventory might have been lost or stolen, or there could be some human error involved. Who knows? Who knows? But this uncertainty pushes some businesses to double check their inventory numbers using periodic inventory counts. The advantages of the periodic system are that it's relatively simple and setup costs tend to be lower. However, since you're only checking your inventory levels periodically, this can lead to delayed results. I'll explain how that works later in this video. Another problem with this system is that you have less control over your inventory. It can be hard to know what happened between each inventory count. Now I'm going to show you how the perpetual and periodic inventory systems work, and to help me explain, we'll use an example. Imagine that you own a bookshop. It's the end of September and you're holding 300 books that cost you $8 per unit to buy. In October, you buy another 500 books at the same price, $8 per unit, and you sell 450 books for $15 a unit. Notice that we're keeping the cost price exactly the same in this example. In the real world, it changes, and we need to make assumptions to help us value our inventory. There are 3 ways to do that: FIFO, LIFO, and average cost. I'm going to cover all of these in future videos in this playlist, so remember to hit subscribe if you'd like to see those. But my question here is, how do you account for these transactions using the perpetual and periodic inventory systems? We're going to do it both ways. And what's your cost of goods sold in October? Let's find out. We'll begin with a calculation. At the top, you have your opening inventory plus your additions for October. When you add these together, you work out your cost of goods available for sale. And below that, if you subtract your cost of goods sold, then you come to your closing inventory, your inventory on hand at the end of the period. This calculation is going to be our foundation for the rest of the example. We'll use it to work out your closing inventory and your cost of goods sold for October, using both the perpetual and periodic methods. Now I want you to pay close attention to timing. When is it that you first find out your cost of goods sold under each method? This is key to understanding the difference between the 2 systems. Right, I put together some steps to help us work this out. We'll run through them now, but you can also find them on my inventory systems cheat sheet, where I summarize all of the key points I make in this video on one page. You can help support this channel by buying it on my website. There should be a link to it up here, and I'll drop one in the description as well. Step 1. Last period's closing inventory becomes this period's opening inventory. If we refer back to our calculation, we're thinking about this top line, opening inventory. This is your beginning inventory, the inventory that you have on hand at the start of October. How do we know that? Well, we said you closed out September with 300 books costing $8 per unit. 300 multiplied by $8 gives you $2,400. That's your closing September balance, which you need to bring forward into October. Step 1 is exactly the same whether you're using the perpetual or periodic system, and since inventory is a normal debit account, we can show this opening inventory as a debit of $2,400 on the left-hand side of your inventory T account. Remember, debits always go on the left and credits always go on the right. Always, always, always. Time for step 2, and here's where we start seeing some differences between the two systems.
Under the perpetual system, this is where you record additions in your inventory account. But under the periodic system, this is where you record additions in your purchases account.
In October, you bought 500 books costing you $8 per unit. 500 multiplied by $8 is $4,000. That's your additions for October.
Under the perpetual system, you record these additions as a debit to inventory of $4,000 and, depending on how you settle the transaction, a credit to cash or accounts payable of $4,000. But what about the periodic system? Here, the journal entry is very similar, however there's one subtle difference. You don't debit your inventory account. You debit your purchases account instead. You debit purchases by $4,000 and you credit cash or accounts payable by $4,000.
The purchases account only exists under the periodic inventory system. It holds all of the inventory that you've purchased during a period. At the end of the period, this will get cleared out to zero. I'll show you how that works towards the end of this video. Which brings us on to step 3, how to recognize inventory sales.
Under the perpetual system, this is where you recognize revenue and record cost of goods sold as sales take place. But in the periodic system, you only recognize your revenue as sales take place.
You might remember from my last video that setting inventory triggers 2 journal entries. You recognize revenue in your income statement and you release cost of goods sold from your balance sheet to your income statement.
Under the perpetual system, you'd record this by crediting your revenue account and debiting your cash account or accounts receivable. But how much revenue should you recognize?
Well, you sold 450 books at $15 per unit. 450 multiplied by $15 gives you $6,750.
So you credit revenue by $6,750 to increase your earnings in the income statement, and you debit cash or accounts receivable by $6,750 to increase your assets in the balance sheet. In the second journal entry, you release the cost of goods sold from your balance sheet to your income statement.
You sold 450 books which you bought for $8 per unit. 450 multiplied by $8 is $3,600, and you need to release this from your balance sheet because you're no longer holding this inventory.
So you credit inventory by $3,600 to release it from your balance sheet, and you debit cost of goods sold by $3,600 to record the expense in your income statement.
Okay, but what about the periodic system? In the periodic system, you only recognize your revenue as sales take place. So selling inventory only triggers 1 journal entry to recognize your revenue. You have no idea what your cost of goods sold are at this point because you haven't counted your inventory yet.
So you credit revenue by $6,750 and debit cash or accounts receivable by $6,750. And that's it.
Step 4.
With the perpetual method, inventory is updated in real time. At any given point, you know all of the variables in this calculation, so your closing inventory balance is continuously updated. In this example, your cost of goods available for sale was $6,400 and you sold 450 books costing you $3,600. That's your cost of goods sold. And when we take the difference, you're left with your closing inventory balance of $2,800 in October.
To find your closing inventory and your cost of goods sold under the periodic system, we need to fast forward to the end of October. You still have 2 more steps to get through.
In step 4, you need to clear total purchases to your inventory account. What does that mean? It means that you need to post a journal to clean all of your October inventory additions out of your purchases account and transfer them to your inventory account. So you credit purchases by $4,000 and you debit inventory by $4,000.
This might seem a bit silly with only one addition in this example, but if you buy inventory in multiple batches throughout a period, then this way of doing things is a lot cleaner. Right, it's time for your inventory count. You head to your storage room where you keep all of your books and you physically count all of your inventory on hand. 350 books in total. That's your closing inventory. In step 5, you update your closing inventory and calculate your cost of goods sold. These books cost you $8 each to buy. 350 multiplied by $8 is $2,800. That's your closing inventory balance, which we can pop into the calculation here. But there's one final piece to this puzzle. You still need to find out your cost of goods sold, and you can do that by rearranging this calculation. Your cost of goods available for sale less your closing inventory gives you your cost of goods sold. $6,400 less $2,800 is $3,600. So to recognize this in your income statement, you debit cost of goods sold by $3,600 and you credit inventory by $3,600. You can see that your cost of goods sold under the periodic method is exactly the same as the cost of goods sold you calculated under the perpetual method. The difference is in the timing. In the perpetual system, you were able to see your results in real time because both your revenue and your cost of goods sold were continuously updated as you sold your inventory. However, in the periodic system, you needed to wait for the inventory count at the end of the month to find out your cost of goods sold. It took longer to find out your results.
There you go. You can find my cheat sheet covering periodic and perpetual inventory systems up here. In this next bit, we'll cover 3 inventory cost flow assumptions: FIFO, LIFO, and AVCO. We'll start with FIFO, which stands for first in, first out. I'll show you a 4-step process to calculate cost of goods sold and closing inventory.
When do we need inventory cost flow assumptions? Let's think back to our inventory calculation from the previous video. Opening inventory plus additions gives us cost of goods available for sale, and when we subtract our cost of goods sold from this, we get our closing inventory. Now here's the thing. Up until now, we've assumed one constant cost price across all of your inventory, but in reality, this isn't always the case. Your opening inventory might have cost you $2 per unit, but your additions might have cost you $3 per unit. So your inventory on hand or your cost of goods available for sale could be made up of a whole mix of $2 and $3 units. And when you get around to making a sale, you need to work out how much of this cost needs to flow out of the inventory account in your balance sheet into your cost of goods sold account, an expense account kept in your income statement. And also, how much of this cost should remain where it is in your closing inventory. To work this out, you can use cost flow assumptions. Cost flow assumptions are rules that help us estimate what these cost flows are. These are assumptions, so they don't necessarily reflect the reality of underlying transactions. There are 3 main types of cost flow assumption: FIFO, LIFO, and AVCO. First in, first out, last in, first out, and the average cost method. Okay, so FIFO, first in, first out. What's this all about? When you make a sale using the FIFO method, you make the assumption that your oldest inventory is going to be sold first. Your oldest inventory is what you bought first, so you're going to imagine that you sell it first every time. First in, first out. But how do you account for this? I think it's time for an example. Business is booming in the window cleaning industry. Word of this catches your ears and you decide to get into wholesale, buying and selling squidgies in bulk. Yeah, that's what these are called. Squidgies! It's the beginning of November and you have 220 squidgies in your inventory. You bought these for $2 each. On November 5th, you buy another 400 squidgies for $1,200. And on November 12th, you sell 500 squidgies for $2,750. Question: what's your cost of goods sold and closing inventory for November, assuming that no other transactions have taken place and that you're using the FIFO cost flow assumption? First in, first out. To help you get to the bottom of this, I've put together 4 steps, which we're going to run through now, but you can also find them on my cheat sheet. You can help support this channel by buying it on my website. I'll link to it down below.
Step 1. Draw an inventory cost flow table. What on earth is that? It's a table made up of 5 columns: date, description, quantity, cost per unit, and total cost. Okay, step 2. Enter what you know. Here's where we use the information given to us to fill out as much of this table as possible. So let's do that.
You began November with 220 squidgies, which cost you $2 per unit.
So, on November 1st, you had an opening inventory made up of 220 units, which cost you $2 per unit.
A few days later, you bought another 400 squidgies, which cost you $1,200 in total. We'll add that to the table as well.
On November 5th, you made additions of 400 units, which cost you $1,200 in total. In an inventory cost flow table, you want to leave an empty row beneath every addition or sale. This is where your subtotals are going to go: your goods available for sale or your closing inventory after the final transaction. It will become clear why in a moment.
Okay, finally, on November 12th, you sold 500 squidgies for $2,750.
So, on November 12th, you sold 500 units, which needs to be negative because you no longer own these squeegees. The sale reduced your inventory on hand, and you sold these for $2,750. So we'll deduct that here.
Hold up, wait, we can't do that. You sold 500 squidgies for $2,750. This is the revenue that you made, not what these squidgies actually cost you.
So we can't enter the $2,750 into your total cost of goods sold. We'll have to work this one out. We're also going to need to work out your closing inventory at the end of the month on November 30th, which brings us on to step 3. It's time to fill in the blanks. There are a couple of things to be aware of when filling out a cost flow table under FIFO. We'll need to calculate the cost per unit of your opening inventory and additions, but you can ignore the cost per unit of your goods available for sale, goods sold, and closing inventory. We'll start off by calculating the total cost of your opening inventory. You began the month holding 220 units, which cost you $2 per unit. 220 multiplied by $2 is $440. Next up, we have to work out the cost per unit of your additions. You bought 400 units, costing you a total of $1,200. $1,200 divided by 400 units is $3 per unit.
That's quite an increase from the cost per unit of your opening inventory. Something to bear in mind when picking inventory cost flow assumptions, but more on that soon.
Now, we'll take some subtotals to work out your goods available for sale. 220 units plus 400 units is 620 units available for sale, and $440 plus $1,200 is $1,640, your total cost of goods available for sale. Remember, I said that under FIFO we can keep the cost per unit of your goods available for sale and goods sold blank. That means we can move on to working out your total cost of goods sold.
Here's where FIFO comes in. First in, first out. You sold 500 units, but what did it cost you? Well, under FIFO, the first units you bought in are the first to be sold.
You had an opening inventory of 220 units, which cost you $2 per unit, but you still need to sell another 280 units to reach 500. The next 280 units come from your additions, which cost you $3 per unit. So here's our workings. 220 units multiplied by $2 is $440. And 280 units multiplied by $3 is $840. 440 plus 840 is $1,280. This is your total cost of goods sold.
Nice work. That was the hard part. Now let's take some totals to find out your closing inventory on November 30th.
620 minus 500 gives you 120 units.
and 1,640 minus 1,280 gives you $360, your total cost of closing inventory. Step 4. Calculate your total cost of goods sold and your closing inventory. Well, like I said, the hard part is over. Your total cost of goods sold for the month can be calculated by adding up your cost of goods sold for each sale. Here you've only made one sale, so your total cost of goods sold for November is $1,280, and the total cost of your closing inventory is $360. The inventory cost flow table makes it easy for us to work these out. And if any of this looks familiar to you, it's because it mirrors the inventory calculation that we had up earlier.
So why would you choose the FIFO method? Well, it's one of the easiest cost flow assumptions to use in practice. And in an inflationary economy where prices are rising, the cost of your inventory might be going up like it did in this example. So choosing FIFO can make your profits look bigger because you're matching your current revenues against your older, cheaper cost of goods. Revenue less cost of goods sold is gross profit.
And as you can see in this example, your gross profit calculated under FIFO is larger than your gross profit calculated using the LIFO or AVCO methods. But as a business owner, this isn't necessarily a good thing. High profits can mean high taxes, which can negatively impact your cash flow. So if possible, it's worth considering the last in, first out or average cost methods. In my next 2 videos, we'll explore these.
So let's see how they work. We'll begin with LIFO, which means last in, first out.
When you make a sale using the LIFO method, you make the assumption that your newest inventory will be sold first. Last to come in, first to go out.
Time for an example. We're going to use the same one that we did in the FIFO video, which means squidgies. It's the start of November and you have 220 squidgies in your inventory. These cost you $2 each. On November 5th, you buy another 400 squidgies for $1,200. And a few days later, on November 12th, you sell 500 squidgies for $2,750. What's your cost of goods sold and closing inventory for November, assuming that you're using the LIFO cost flow assumption? Last in, first out. It's time for some steps. We'll go through them now, but you can also get them on my inventory cost flow assumptions cheat sheet. If you're finding these accounting tutorials at all helpful and you'd like to help support the channel, then the best way you can do that is by buying one of my cheat sheets. You can find the link up here and down below as usual.
Step 1. Draw an inventory cost flow table. This is a table made up of 5 columns: date, description, quantity, cost per unit, and total cost. Step 2. Enter what you know. What do we know?
We know that you began November with 220 squidgies, which cost you $2 per unit.
So at the start of November, you had an opening inventory of 220 units, which cost you $2 each.
On November 5th, you went and bought another 400 squidgies, costing you $1,200 in total. This belongs in the table as well.
On November 5th, you added 400 units to your inventory, which came to $1,200.
In inventory cost flow tables, you want to leave blank rows beneath each addition or sale. This gives you some room to put your goods available for sale, which is the subtotal of the rows directly above it. On November 12th, you sold 500 squidgies for $2,750. Now be careful here. This $2,750 is the revenue that you've earned, not the cost of goods sold that you've incurred, so it doesn't belong in the inventory cost flow table.
So on November 12th, you sold 500 units, and that's all we know about this transaction. We'll need to work out your total cost of goods sold later. We're also going to calculate your closing inventory on November 30th. Right, step 3. We need to fill in the blanks. We'll begin by calculating the total cost of your opening inventory. You kicked off the month with 220 units, which cost you $2 per unit. 220 multiplied by $2 is $440. Next, we'll work out the cost per unit of your additions. You bought 400 units, which cost you $1,200 in total. $1,200 divided by 400 units is $3 per unit. Now we can take some subtotals to work out your goods available for sale. 220 plus 400 is 620 units available for sale. And 440 plus 1,200 is $1,640, your total cost of goods available for sale. When using the LIFO or FIFO methods, you can ignore the cost per unit of your goods available for sale, goods sold, and closing inventory. So we can move on and calculate your total cost of goods sold. You sold 500 units, but what was the cost of goods sold that you incurred in this transaction? Remember, LIFO means last in, first out. The last squidgies you bought were your additions of 400 units, which cost you $3 per unit, but you still need to sell another 100 units to reach 500. The next 100 units come from your opening inventory, which cost you $2 per unit. So let's work this out. 400 units multiplied by $3 is $1,200. And 100 units multiplied by $2 is $200. 1,200 plus 200 is $1,400. This is your total cost of goods sold. Great, that's the tough bit out of the way. Now let's find out your closing inventory on November 30th. To do that, we need to take some totals. 620 minus 500 gives you 120 units. And 1,640 minus 1,400 gives you $240. Alright, step 4. Calculate your total cost of goods sold and your closing inventory. Your total cost of goods sold for the month can be calculated by adding up your cost of goods sold for every sale that you've made. In this example, you only made one sale, so your total cost of goods sold for November is $1,400, and the total cost of your closing inventory is $240. Boom! You can use these same 4 steps to solve any inventory cost flow problem. Now let's have another look at the inventory calculation. Why would you choose LIFO over the other inventory cost flow assumptions? This method allows you to match your current revenues against your most recent cost of goods, so your gross profit reflects your business's current performance. However, when prices are rising during times of inflation, your most recent cost of goods are also your highest, which gives you a higher cost of goods sold. Remember, those squidgies in the example went from costing $2 per unit to $3 per unit. This gives you a lower gross profit. So when we compare your results using LIFO against the FIFO and AVCO methods, your gross profit under LIFO comes in the lowest. But as a business owner, this can be a good thing. Businesses are charged tax on their profits. So lower profits means lower taxes, which can free up more cash for you to use in other areas of your business, at least in the short term. But be careful, last in first out is not allowed under IFRS. So if you follow international financial reporting standards, then you'll need to use first in first out or the average cost method instead.
Well, there's only one cost flow assumption left, and that's AVCO, the average cost method. Let me show you how that works.
So, the weighted average cost method. It's a bit of a mouthful, which is why sometimes you might hear it shortened to WAVCO, or the average cost method, or just plain AVCO. That's the one I like. It can all seem a bit confusing, but just remember that all of these terms mean the same thing. They describe an inventory cost flow assumption. What does that mean? How does that work? Let's find out. It all comes down to the inventory calculation. Your opening inventory plus your additions gives you your cost of goods available for sale. And when you take away your cost of goods sold from it, you get your closing inventory. Remember, when I say inventory, I mean the goods held by your business that you intend to sell to earn revenue. The thing is, when you make a sale, you don't only earn revenue, you also incur a cost. And inventory cost flow assumptions help you estimate what that cost should be. There are 3 inventory cost flow assumptions:
FIFO, LIFO, and AVCO. First in, first out, last in, first out, and the average cost or weighted average cost method. When you make a sale using AVCO, you assume that all of your goods available for sale are valued at their weighted average cost per unit. It doesn't matter what order you bought your inventory, you assume that it all gets mixed up together, whether or not that's the case in reality. Remember, this is an assumption. You can work out your weighted average cost per unit by taking your total cost of goods available for sale and dividing it by your quantity of goods available for sale.
Don't worry, we'll come back to this equation soon, but first, I'd like to give it some context. Let's imagine that you work in wholesale in the window cleaning industry, buying and selling squidgies. It's the beginning of November and you have an opening inventory of 220 squidgies, which each cost you $2 per unit. On November 5th, you go and buy another 400 more squidgies for $1,200 in total. And on November 12th, you manage to sell 500 squidgies for $2,750. The question is, what's your cost of goods sold and closing inventory for November, assuming that you're using the weighted average cost method to value your inventory? It's time for that 4-step process.
Step 1. Draw an inventory cost flow table. What's that? It's a table with 5 columns: date, description, quantity, cost per unit, and total cost. Step 2. Enter what you know. Okay.
Well, we know that you started in November with 220 squidgies, which cost you $2 each.
So at the start of November, you had an opening inventory of 220 units, which cost you $2 per unit.
A few days later, on November 5th, you purchased another 400 squidgies for a total cost of $1,200. We'll need to pop this in the table too.
On November 5th, you made additions of 400 units, which cost you a total of $1,200. In inventory cost flow tables, it's important to leave a blank row under each addition or sale. This gives you some space to calculate your goods available for sale.
Finally, on November 12th, you sold 500 squidgies and earned $2,750 in revenue. Now be careful here. This is the revenue that you've earned, not the cost of goods sold that you incurred. So this doesn't have a place in the inventory cost flow table.
That means on November 12th, you sold 500 units, but we don't know your total cost of goods sold yet. We'll work this out along with your closing inventory on November 30th. Time for step 3, fill in the blanks. We'll start by working out the total cost of your opening inventory. You began the month with 220 units, which cost you $2 per unit. 220 multiplied by $2 is $440. Next, we need to find the cost per unit of your additions. You bought 400 units, which cost you $1,200 in total. $1,200 divided by 400 units is $3 per unit. To work out your goods available for sale, we'll need to take some subtotals. 220 plus 400 is 620 units available for sale, and 440 plus 1,200 is $1,640, your total cost of goods available for sale.
Okay, here's where the AVCO equation comes in. We need to work out the weighted average cost per unit of your goods available for sale.
This is your total cost of goods available for sale divided by your quantity of goods available for sale. Right, so your total cost of goods available for sale is $1,640 and your quantity of goods available for sale is 620 units. 1,640 divided by 620 is 2.64516,129. But we'll round this to $2.65 per unit. $2.65, the weighted average cost per unit of your goods available for sale.
Alright, keep this number in mind for the next bit. We'll be using it to work out your total cost of goods sold.
Your total cost of goods sold is your quantity of goods sold
multiplied by the weighted average cost per unit of goods sold. We already know that you sold 500 units, but what's your weighted average cost per unit of goods sold? It's exactly the same as the weighted average cost per unit of your goods available for sale, $2.65 per unit. So 500 units multiplied by $2.65 is $1,325, your total cost of goods sold. Right, now let's jump forward to the end of the month and work out your closing inventory on November 30th. How many units of inventory do you have left over? Well, 620 minus 500 gives you 120 units. And the total cost of your closing inventory is 1,640 minus 1,325, which is $315 of inventory on hand kept in your balance sheet. Remember, we rounded your cost per unit earlier on, so this is an estimate. Step 4. Calculate your total cost of goods sold and your closing inventory. Your total cost of goods sold for the month can be calculated by adding up your cost of goods sold for every sale that you've made. In this problem, there was only one sale, so your total cost of goods sold for November is $1,325, and you can find the total cost of your closing inventory down here in the bottom right corner, $315. Okay, now I'd like to show you something interesting. This inventory cost flow table mirrors the inventory calculation that we had up at the start of the video. Neat, hey? But what are the implications of using the weighted average cost method? AVCO matches your current revenues against your average cost of goods. It's like the middle ground between the first in, first out and last in, first out methods. What do I mean by that? Well, FIFO matches your current revenues against your older cost of goods, whereas LIFO matches your current revenues against your most recent cost of goods. AVCO falls somewhere in the middle. It uses a weighted average. So for example, during times of inflation where cost prices are rising, your cost of goods sold under LIFO tend to come out the highest because it reflects your most recent purchases. And your cost of goods sold under FIFO would come out the lowest, because this assumes that you're selling off your older, cheaper inventory first. With the average cost method, your results come out somewhere in the middle.
There you go. That's merchandising inventory in a nutshell. We didn't really get on to manufacturing inventory. If you'd like me to cover that too, then please let me know in the comments. I've left links to my inventory cheat sheets down in the description, and if you'd like to learn more, then why not give this video a watch next? And I'll see you there.